So the MEC test is what? The first 7 years of a life insurance policy. Important to be aware of that. However, is it possible that you can run into a modified endowment contract, a MEC, after the first 7 years? The answer is yes. And it's very important to provide full transparency on this topic because people have gotten into trouble with this. Now, it's easy to prevent and reverse, but there's not much transparency on this. So with a life insurance policy, the terminology the life insurance industry uses is this guy, material change. This can occur with a life insurance policy, and the outcome can often be a MEC, a modified endowment contract. So what is a material change with a life insurance policy? Well, it is an adjustment to the total benefits of a policy, specifically referring to the death benefit. With a life insurance policy, we have the initial, what was it? That Mech Limit 7-pay premium test, first 7 years of a life insurance policy. Now, does it stop after the first 7 years? Because I've spoken with a number of professionals that thought it had, that after the first 7 years, you're beyond the MEC test, you're good. I used to think that when I first got into the industry. It doesn't work like that. I wish that it did. The Mech limit will typically reset every 7 years. Now, I say typically reset every 7 years. If a material change occurs on a life insurance policy, that will make the policy subject to a new 7-pay test, a new 7 years where the Mech limit resets. In past videos, years ago, I'd always say, with a MEC test, you've got the initial 7-pay test, 7 years. What happens, something like this. This is usually the pattern it follows. For every 7 years, it gradually decreases. Now you can prevent that as well, depending on the company and the design, but it will often gradually decrease if you're constantly pumping money into it is the big thing. So, material change, what triggers that? So the MEC limit can reset every 7 years, or your policy can be subject to a new 7-pay test if there's a material change or change to benefit to the policy. Well, what are some examples of a material change? That's what would be my follow-up question. Face amount increase. If I make any changes to the death benefit. So if I like to go through underwriting and add a term rider or pump my death benefit up, that'll be classified as a material change. If I pump money into PUAs, often people do this for what? To continuously grow the cash value. However, PUA stands for paid up additions. When I make a payment there, those dollars will purchase me paid up additional life insurance, additional death benefit, which is classified as a material change. This is often where people run into modified endowment contracts down the road, when they continue to pump money into PUAs and the policy was not MEC tested based on conservative dividends and a guaranteed rate. That's when it happens, which is easy to prevent, but that's typically what we see, or we've seen, I should say. Term rider reduction and or removal. So if I have a term rider, we see this a lot with level term riders that fall off after a certain period of time. If I have a term rider that's a level 7-year, level 10-year, level 20-year term rider, when that term rider falls off, there's going to be a material change and the death benefit will drop, the MEC limit will drop, and I will be forced to pay a lesser amount of money into that life insurance policy once that term rider falls off. With 1-year term riders, that's not the case unless I'm manually reducing it or if it burns out altogether. Company selection is important in that case, and I can get very technical there. We've got other content on that. Here's just a bullet point I want to mention. We can prevent a long-term MEC, so I'm specifically referring to this guy. If you have a policy where you say, I want to be able to pay as much money into this policy for as long as possible, that is my specific goal here, and I don't want to run into a MEC. We want to prevent a long-term MEC in this case. How you do that, or how your agent does that, is MEC test the policy mainly by looking at the guarantees. What I like to do in these particular cases, if someone says, hey, I want to have a policy where I just shove money into it, I want a 10/90 split, I want to break even between years 3 and 5, and I want to pay into it for 40 years until I'm 70 years old or something like that. What I'll do, because this is important, is test the policy based on the present dividend rate, then also a conservative dividend rate, I'll often cut it in half, and then also just the guarantees. because where people have run into MEC issues, specifically with high cash value life insurance products, is when the current illustration said the policy would not MEC and it MEC'd down the road. It was a result of dividends coming down and that death benefit did not grow at the fast pace that it originally projected on that original illustration. The death benefit has a direct relationship to the Mech limit. No, that's technical, but it's easy to prevent as long as you forecast it. So let's continue on here. Some good stuff we're going to touch on next. The Mech limit. Very important subject here. So on that Mech limit, you can set it wherever you want. On the illustrations we touched on earlier, it has a direct relationship to an individual's age and total death benefit. So, Mech limit, again, you can set it. If I want the ability to pay in $100,000 per year, I'm going to design the policy to have a $100,000 Mech limit. If I want a policy with a $5 million Mech limit, I'm going to set the policy up to have a $5 million Mech limit. Or I'm sorry, if I want the ability to pay in $5 million per year, I'm going to have a $5 million Mech limit. It's a big number. So how do I set that Mech limit? Age, total death benefit, emphasizing the word total because a term insurance rider and even PUAs will impact that initially, gender, and then also the guaranteed rate. Since the new 7702 change, where all life insurance companies typically have different guaranteed rates or can have different guaranteed rates, this now becomes a topic to be more aware of with respect to MEC testing. And again, if you're a consumer and you're looking at this, you're thinking, oh my goodness, don't worry, your agent knows all this stuff. If you're working with us, we know all this stuff. But here we go. How this piece works. Because in the past, I'd always say that the Mech limit has a direct relationship to an individual's age and total death benefit, which it does. But then also, I've got this to be aware of. If you have an old policy with a guaranteed rate of 4%, and you're a 40-year-old male, you would have needed, because we can't get these policies anymore, a total death benefit of $2.8 million at a minimum to obtain a $100,000 Mech limit. So, an individual's age and death benefit, the product of a guaranteed rate of 4%, $2.8 million, gives me a $100,000 Mech limit. If I have a product with a 3% guaranteed rate, now that same 40-year-old male needs a total death benefit of just over $2 million to obtain the same $100,000 Mech limit. The lesser the guaranteed rate, the less life insurance I need to be able to pay in the same amount of money. Fun stuff, right? Guaranteed rate of 2%. I need a death benefit. It's actually a little bit less than this, $1.45 million, to obtain that same $100,000 Mech limit. If you have a guaranteed rate of 2.5%, then I'm going to need just about 1.7 to get that same $100,000 Mech limit. And how you can tell is the examples we looked at with the 100K per year. This example we referenced earlier has, guess what? A $100,000 Mech limit and a 2.5% guaranteed rate. So there's your total death benefit, just over 1.7 in this particular example. But that can always be run with any company and any illustration, fairly easy to project up front. So we are just about at the finish line here with respect to setting the Mech limit. So the last thing I want to touch on here, and this will kind of close this video out and this discussion, is if you're thinking, okay, like this stuff is good from an informational standpoint, but how do I make sure I'm getting the best possible deal if my goal is maximum cash value? So if you said, I want a whole life insurance policy, I want maximum cash value from start to finish. I want to make sure a MEC never occurs. Like, with all of this said, how do I set a policy up appropriately where I've got maximum cash value and no chances of a MEC occurring? So, one of my favorite things to discuss, if you've seen any of our videos, you know this, policy design. Where is your money going? We've got a line added to this one, MEC. So at the end of the day, your money can go toward two primary areas, the base premium or your PUA rider. Notice we'll have a term insurance rider. We have a term insurance rider in this one too. So premium dollars. What happens here? Any premium dollars you pay in, let's say you pay in, let's do this a little bit differently, $10,000. What will that give you in cash value in the first year? Typically nothing. That'll buy you a death benefit of, let's say, $500,000. Okay, shrink this down a bit. Cool board, right? I do like this, mainly because I've got very, very bad handwriting, and this improves it. Or makes it smaller, which makes it appear to be improved. But here's what I want to mention here, that $10,000 base premium, that was our base, gave us no cash value in the first year, sometimes the first and second. Eventually that comes back to cash value for you. But right here, that $500,000 death benefit may obtain you a Mech limit, call it of $25,000. So what that means is you can pay in a maximum of $25,000 per year with a $10,000 base premium. Now what a lot of corporations do is they want rich cash value right off the bat, minimum premium, and getting as much money into PUAs as possible, and have a non-MEC. They want the best of all worlds. And it is possible because insurance companies want corporations' business because they're large deposits, large premium deposits. But the thing is, individuals can have the same thing. So what we can do here is we can add a term rider. I'm just going to call it $1,000 in this example. That does not build any cash value. It'll be less than $1,000. But that will give me, let's call it another 1.5 million. 1.5 million, which may get me another $75,000 in MEC space. So what this allows me to do is raise the death benefit, which mainly raises the MEC limit in the cheapest, if you don't like the word cheap, the most cost-effective manner so I can keep my premium low. People don't like that because it doesn't build any cash value in the first year. This allows me to keep the premium as low as possible, boost my MEC limit up to the amount I need or want, and then I can do something like this. And that makes me happy. I've got more money in cash value. Paid up additions will buy me some death benefit as well, which will push my MEC limit up a little bit. Sometimes every time we'll consider that in the overall policy design. But what this allows me to do is set my MEC limit wherever I want. So in this particular case, when we add those two together, what do we have? $100,000 MEC limit, $10,000 minimum base premium, assuming the insurance company will allow me to 10x my minimum base premium, which the example we had up on the screen, this was actually with Mass Mutual. Their maximum allowable limits that they will allow you to pay into a policy per year is 10x the base premium. If you try to submit a policy for issue with a greater limitation than that, or a greater PUA payment than that, they'll reject it. That is the maximum. The software makes you aware of that as well, but 10 times is the maximum limit. So what I want to be aware of is what is the insurance company limitations and also the IRS limitations in an effort to maximize my cash value. Very easy to understand, isn't it? So overall, I hope that this video was helpful just with respect to the modified endowment contract, bullet points to be aware of, the MEC limit, how that works, how we can set it wherever we want, how to stress test the policy by looking at a conservative dividend rate, also the guarantees. One thing, I mentioned this in the beginning, if you ever do trigger a MEC, no need to worry, no need to panic. What happens is the day after it occurs, the next business day, the insurance company will notify your agent, they will notify you, and if it happened by accident, if you don't want a MEC, typically all that is needed is an email from you to the agent, which your agent can then forward to the insurance company saying, hey, I don't want a MEC, can we please reverse it? And they will refund you the difference, or if it was a transaction where I removed the term rider or something by accident online, because you can do that with some companies through an online portal, they'll refund or they'll reverse the transaction as long as it is done within 30 days typically you're in the clear and we're notified the next day. So that gives us plenty of time in that respect. So I hope you enjoyed this one. If you did, please hit the like button, subscribe for more. If you have any questions or would like to leave comments, please comment below. Reach out to us anytime. And thank you so much. As always, I hope this helps. Enjoy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.